The average home in America hasn't been under $100,000 since what, the mid-1980s? And if you've been anywhere near a housing headline in the last 5 years, you probably figured homes at that price just don't exist anymore. Like, there's some relic from your parents' era, gone for good. But they're not gone. So if you're sitting there in some city where a starter home runs $400,000 and you've genuinely started to wonder if there's anywhere left where a regular person can buy something without a six-figure household income, yeah, these places are out there. They exist. So where exactly are these sub-$100,000 homes? And why are they this cheap when everything else keeps climbing? Let's start with the first state, Michigan, and more specifically, the city that has more of them than anywhere else, Detroit. Recent data from Realtor.com shows 2,463 active listings under $100,000 in the city of Detroit, out of roughly 4,458 total. That's where that 55% number comes from. More than half of everything for sale in the entire city. Now you've got to be careful with how you read that, because the city of Detroit and the Detroit metro area are two completely different markets. As of early 2026, the metro area median sits around $195,000, which is nearly double that sub-$100,000 tier. So all those cheap listings are concentrated inside the city itself. They're not spread out across the suburbs and the surrounding counties. And honestly, that distinction matters more than most people realize. The reason Detroit has this kind of inventory is the same story that's been making headlines for decades. People left. The factories shut down. The jobs moved somewhere else. The population shrank. But all those houses just stayed behind. And analysts have pointed out something pretty straightforward. A lot of the cheapest markets in the country are cheap specifically because people keep leaving. And that same outflow can limit how much your home actually goes up in value over time. Ohio tells a really similar story. Toledo, as of late 2024, had close to 44% of its active listings under $100,000, and Cleveland came in just over 36%. Same Rust Belt pattern. Industrial decline, population loss, way more housing supply than there is demand. The numbers are real, the homes are real, but the reason they're affordable is also the exact reason you need to think twice about what they'll be worth down the road. And that's the tension you have to hold in your head with markets like these. The opportunity is genuine. You can actually buy a house. But the very thing that made it affordable, which is decades of people packing up and leaving, is also the thing that might mean your home isn't worth much more 10 years from now than it is today. If you're a family trying to build something stable, that's not some minor detail you can just wave away. Now, Michigan and Ohio are former manufacturing giants. But does this pattern stretch further south, into states that never really had the same factory economy? It does. The next state is Missouri. St. Louis had about 23% of its active listings under $100,000 as of late 2024. Same post-industrial dynamic at work. You don't really need me to re-explain it. The Rust Belt's shadow reaches a lot further than the map would suggest. But West Virginia is a totally different animal. As of early 2026, the statewide median home price there is roughly $148,000, which is the lowest of any state in the country. And the property tax rate? Just 0.57%. On paper, that looks like a dream. Cheap homes, low taxes, mountain scenery everywhere you look. But the same engine is running underneath all of it. Analysts at Opendoor have noted that markets losing population tend to see home values get suppressed over time, and West Virginia has been losing residents for years. So yeah, you can get in cheap. That part's absolutely true. But getting out, or building any real equity, is a completely different question. A decade from now, that house might actually be worth less than what you paid for it. And for a family putting their savings into a home, that's the difference between building wealth and just watching your money sit there doing nothing. Okay, so population loss explains the rock bottom prices. But what happens in states where the risk isn't people leaving? It's storms showing up. Mississippi's statewide median is around $177,000 as of early 2026. So there's plenty of room for sub-$100,000 homes. But the sticker price starts lying to you here. True affordability is what you actually pay every single month after you move in. Property taxes, insurance, maintenance, whether there are jobs nearby. And in storm-prone states, insurance is where the math just completely falls apart. According to Opendoor's analysis, homeowners insurance in high-risk storm states can run roughly 2 to 3 times higher than in calmer parts of the country. Think $2,000 to $3,500 a year compared to $1,000 to $1,500 somewhere else. That's a second bill that hits you every single month, whether the storm touches your house or not. Oklahoma follows the same pattern, but from a different angle. Tulsa had about 14% of its active listings under $100,000 as of late 2024, and the statewide prices are pretty modest overall. But Oklahoma sits right in Tornado Alley, and the insurance math looks a lot like what you just heard about Mississippi. Different hazard, same hit to your budget. So picture this. You celebrate buying a $90,000 house, you're feeling great about it, and then you find out your annual insurance bill rivals or even exceeds your property taxes and maintenance combined. All of a sudden, that cheap home starts costing you real money every single month. And that never shows up in the headline price. It's what makes you sit down with a calculator and realize the deal isn't quite what it looked like from the outside. So far, every cheap state has come with a pretty clear downside: decline, storms, hidden costs. But are there any where the economy is actually growing and buying cheap isn't just trading one problem for another? Actually, there are. Fort Wayne, Indiana had about 19.5% of its active listings under $100,000 as of late 2024. Indiana's statewide median is around $232,000 as of early 2026. And while it's got that same manufacturing heritage as the rest of the Rust Belt, the economy there has diversified more than some of its neighbors. It's not exactly a boomtown, but it's not hollowing out either, and that difference matters. And then there's Arkansas, with the statewide median around $189,000 as of early 2026. Arkansas is different because of what's been happening in the northwest corner of the state. The Bentonville-Rogers-Fayetteville corridor, which is anchored by Walmart's headquarters, has quietly built up a tech and corporate ecosystem in a state where the overall cost of living stays low. On top of that, Open Doors analysis has flagged remote work as another factor making these cheaper markets more viable. Because if your paycheck doesn't depend on a coastal zip code, a state like Arkansas starts looking very different to you. For a buyer who actually does the homework, these markets offer something the others didn't. You can get in at an affordable price, and there's a plausible reason to believe the local economy will still be standing 10 years from now. So if homes under $100,000 exist in real volume, and some of these states even have growing economies, what's actually stopping people from buying them? The answer is the mortgage system itself. According to Tara Roche, who's a project director for housing policy at the Pew Charitable Trusts, the fixed costs lenders deal with on every loan make small mortgages hard to justify financially. Think about it. The paperwork, the appraisal, all the compliance work. It costs a lender roughly the same amount, whether the loan is $55,000 or $550,000. But the interest income on that tiny loan doesn't come anywhere close to covering those costs. So lenders just don't write them. It's that simple. Craig Richardson, a professor of economics and finance at Winston-Salem State University, saw this play out firsthand. He went on Zillow and started browsing homes under $100,000 near where he lives in North Carolina. And in his own words, "I'm looking at a 2-bedroom, 1-bath, 729 square feet. That's a nice little cottage. Another one is $55,000. It's a multi-family home. Another condo is $89,000. Real homes, real prices, listed right now." And he couldn't get a standalone mortgage for a single one of them. $55,000. That's the price of a used truck in some parts of this country. And no mainstream lender will write you a mortgage for it. You could walk into a bank with good credit, stable income, a down payment ready to go, and they'll tell you no. Nothing is wrong with you. The bank just can't make money on a loan that small. Richardson eventually bought a similarly priced condo as an investment, but to pull it off, he had to engineer a workaround. He refinanced his existing home and wrapped the condo purchase into that larger loan. So here's an economics professor, a guy who literally teaches money for a living, and he had to come up with a strategy that most first-time buyers can't even attempt because it requires already owning a more expensive property. This isn't some weird edge case. The system is failing at the exact price tier that could give modest income Americans their way in. And without access to traditional mortgages, buyers at this price level typically end up either paying cash, which most people obviously can't do, or turning to riskier arrangements: land contracts, rent-to-own deals, lease purchase agreements. These options come with their own legal and financial risks that most buyers just aren't equipped to navigate on their own. So if the system is clearly broken at this price level, is anyone trying to fix it? And what can you actually do right now without sitting around waiting for Washington? First, the thing that's completely in your control: Before you buy anything in any of these states, add up the real cost on top of the price. Property taxes, insurance, the local job market, whether you can even get decent broadband, school quality. A home in an above-average tax state can cost you $2,500 to $3,000 a year just in property taxes on a median-priced home. States like Iowa and Kansas run 1.3 to 1.5%, while Alabama and West Virginia sit at less than half that. The listing price is where the math starts, not where it ends. Second, you need to understand what financing actually looks like at this price level right now. As Roche and the Pew team have documented, buyers of cheap homes today are typically paying cash or using alternative arrangements like land contracts and rent-to-own deals. Those options exist, but they carry real risks, fewer consumer protections, less legal clarity, and terms that can shift against you without much warning. I'm not recommending them. I'm telling you that's the current reality of what's available. That bundling workaround Richardson used, wrapping a small property into a refinance of a larger existing loan, is one path, but it only works if you already own a more expensive home. So if you're a first-time buyer, that door is basically closed. And on the systemic side, Congress has actually passed a bipartisan housing bill, though it still needs to be signed by the president, that would create a framework to eventually make small mortgages more accessible. According to Roberto Quercia, a professor of housing and community development at UNC Chapel Hill, the bill creates a policy and regulatory framework to eventually implement changes. But even with that in the works, Quercia still doesn't think $100,000 mortgages will be easy to find anytime soon. So the bill is real, the workarounds exist, and the due diligence checklist is something you can sit down and work through tonight if you wanted to. But the system hasn't caught up yet. It's starting to move slowly, and it still hasn't reached the people who need it most. The homes are real. The catches are real. The financing barrier is real. And now you know all three. That doesn't make any of this easy, but it means if you decide to go down this road, at least you're going in with your eyes open.